I am fine. How are you?
Alhamdulillah, all fine.
Okay, I thought people are not joined. People are joining now. We'll
It's
give
it's.
two, 3 minutes for them more.
Generally, yes, people join within 5 minutes of the call starting, so I'm not too surprised by that. But I'm sure
Yeah,
there's enough interest, at least from our side, to interact with
yeah,
you and the team.
yeah. So we'll just wait for 5 more minutes, then we'll start.
Sounds good. Yes. Okay.
Yeah, Assalamu alaikum. I think we have given 4 minutes, so we are going to start now the investor meet for 2023. My name is Mohammed Ajmal Basha. I'm the CEO of Voltam Energy. Along with me, I have Rajesh Khanna, who's the finance controller, Mr. Abdullah Umar, who is the general manager corporate affairs, Mohammed Shaksi, who is the legal officer, Nabil Nas, who has recently joined to head finance and accounts. Ahmed Kharusi is there, who is the general manager for distribution transfer. Khalid is there for IT. Online, Anirban Saha has joined, who is our general manager for power transformer. During the course of the meeting, we'll have Abdullah Vehebi, who is also the general manager of switchgear and ESD. I'm just going to put a presentation for the sake of understanding where we stand on 2023. Are you able to see my screen?
Yes.
Okay. So we are talking about 2023 investor relationship meeting. Today is 18th April 2024. So this is the key performance for the year 2023. The sales we have done at the group level of 30.51 million Omani Riyal. The raw material cost, which is the main contributor for the cost, is 19.79 million, which attributes to 64.86% of RMC, which is improved in a greater leap. I'll explain you further in the slide. Gross profit is 6.63 million, which is 21.73%, which is also exceptionally high. We made a profit of 977,000, which is 3.2% of sales, which is also phenomenal considering what we have been through for the last 2-3 years. We had a very good order booking also. We have order booking of 38.32 million, which is much more than what we had last year, as well as in 2022, as well as the sales what we have. And we have operating working capital of 220 days. This is also reduced to almost 14 days as compared to last year. When it comes to order booking, you can see 2022, we were having 36.175 million. We increased from 36.175 million to 38.318 million. There's a growth which is there. 2024, we see this will have a phenomenal increase, probably because of multiple projects which has been done and approval taken. In terms of order distribution, 2022, we had 51% domestic and 49% export. This has been changed to 44% domestic and 56% export. That means our export focus has been very high in terms of order booking. And we got a lot of new market orders which are there that has contributed to the increase in order booking. In terms of sales, there is a reduction in revenue from 35.8 million, 30.5 million, primarily because we have taken the selected orders which are there. And some of the orders have been carried forward to 2024. That's why there's a reduction in sales. Despite of that, we have met our bottom lines in a better manner. If you see sales distribution also, we had 2022, we had sales distribution of 51% domestic, 49% export. This is also increased to 56% export, 44% domestic. We had this 56% primarily coming from African region, GCC region, Saudi Arabia, and Qatar and Yemen. This is the contributor for sales. The reduction of sales also is primarily due to some of the key orders of which we had from African area, which did not got executed in the year. That's as it carry forward. In terms of raw material cost, if you see, the raw material cost of last year was 80.35%, which was the reason for our bottom line issues and all, where the copper, CRGO, and all other key metals went up. And it has come down drastically to 64.88%, primarily because a lot of actions were initiated during the course of time in terms of raw material cost, in terms of approach to a design, supply, negotiation, efficiency, and all. This has resulted into the improvement of the RMC. And this RMC reduction is primarily going to give you benefit in your gross margin, PAT, etc. So this is the biggest change or biggest advantage which has been done in 2023. Across 5 years also, if you see in the bottom slide, the raw material cost which has come in 2023 is exceptionally good as compared to 2019 also. 2020, 2021, 2022 was something which was primarily due to commodity price increase, but 2023 we have managed to get better than 5 years. So there have been consistent working in design material in all the SBUs, and this is the reason for what we are able to achieve. In terms of other costs, from 2022 to 2023, there is an increase from 3.58 million to 4.08. Primary increase is because of the freight outward. We had orders to Nigeria and Libya, which had a delivery on a CFR basis. So the freight cost was large. Because of that freight cost, this is increased. Otherwise, the cost remains much reduced. And you will see, as compared to 5 years, the sales what we have done, we have the increase in, despite of increase in freight cost, the direct cost is not so high. When it comes to selling and administration cost, there is a reduction from 5.3 million to 5.1 million from last year to this year. And this primarily due to controlling costs and restructure of switchgear business. We have done restructure of switchgear business where we have completely revamped how we see switchgear. When we see 5 years target also, last year was quite high, but this year we brought it back to the levels what we were 5 years. We will be able to retain and keep those levels so that our profitability remains there. If you see gross profit, this is a 5 years gross profit margin. What you have, we have done the highest gross profit, which is double what we had done last year, from 3.3 million to 6.6 million. And this 6.6 million is also 5 years highest in terms of that. So this is something which has been a key improvement in 2023. Same thing reflects in profit before tax. Profit before tax of negative 1.6 million has gone to 1.4 million. This is a complete turnaround. If you can see previous 3 years, 2020, 21, 22, we had losses, and this has come to profit, and it is much profitable as compared to 2019 also. So this is a complete turnaround. When it comes to EBITDA, it's a multifold from a 74,000 EBITDA to 2.9 million EBITDA. and which is also again higher than all the 5 years. So this is all contributors towards proper control on the process. So what are the results? What are the contributors for this result? We have some positive contributors. We have some negative contributors. The positive contributors are large and strategic orders in the sales, including repeat jobs, which had high margins. These are one of the key reasons for able to get the higher gross margin despite of lower sales. We monitored raw material very closely. The impacts, the problems what we had in 2021 and 2022, which resulted in a very bad performance of 2022, had been learned very clearly. And at every level in the organization, raw material cost has been monitored very closely, and that has resulted in a better RMC. We had oil and gas orders. We have new market enters. So those orders also has given a better gross margins. Positive cash flow was there because of lower sales, better raw material cost, and better negotiation. Based on that, there was a higher realization. Rather, the collection was more than what we sold. This has reduced the financial cost. That is also contributed to the bottom line. Commodity price are also mostly stable, though in the recent times slightly it's going in a different direction. But otherwise, 2023, the commodity price was mostly stable. We had a lot of improvement in our production efficiency. That also has resulted in the cost reduction. What are the negative contributors? Concern in supply chain is there. This is something which is making us work on inventories, making us work on planning ahead of time so that we don't suck up on our deliveries and get into a cycle of LDs, penalties, and all. So this is a concern which is still ongoing. Changes in regulation is there in some of the market for customs and preferences, like Saudi Arabia. We took strategic decision in Saudi Arabia how to go forward on that. These are also constraints which increases your cost. Chinese expansion is there in the market. We told this last investor meeting also. This is still ongoing. So we are trying to work out on that. IPPs are largely price driven and not allowing local content. So to cater the point number 2 and 3 specifically, we had done a lot of activity on getting the local manufacturer preferences. We petitioned with a lot of ministries, utilities, private companies, all major decision makers, and we were able to have the mandatory listing done with OIA early last month. And this is something which is going to benefit us in terms of how local companies seen. So there are actions which are being done. So we'll see this last two activities, the last two challenges to be mitigated to a greater extent. So this is what we have. You now ask questions if there is any questions from your side that we can answer. Yeah.
السلام ورحمة الله. السلام عليكم محمد.
Waalaikumsalam.
I'm little bit wondering, what's your strategy for managing inventory and logistics, given that the recent change in the market price, like 10 to 12% for the raw material like copper, how might that affect the company, and what's level of stock sufficient for processing order of totaling, as you mentioned, 38 million?
So if you see in 38 million order booking, what we have done, there are, when we entered into 2024, we had entered with the order booking, unexecuted order book of 18 million. Okay, because 20 million was order booked and sold. We entered into 18 million and we booked almost everything of that 18 million copper. We don't have the risk of copper. But going forward, whatever orders we're booking, we will always have a lag of 30 days. 30 days of lag will be there between what we get the order and when we fulfill the copper booking. So what we are trying to do here is we are doing a forecast planning where we are trying to book the copper in advance, and based on that copper advance price, we are going to go to the customer and get the order. So that's how we are trying to mitigate our copper fluctuation.
Okay, so it is quite clear. We have in consideration, like you have completed several of projects for the first quarter, but we see the revenue it's around 6 million, which is falling short of our expectations. So can we anticipate a higher revenue in the second quarter?
If you see quarter one, you're talking about 6.6 million. We have our projection says that quarter two will be higher than quarter one, obviously, and we'll be able to meet whatever we have projected for 2024. So we are very optimistic about meeting our targets for 2024.
Okay, it is clear to me. Last question: what is the latest development regarding the lawsuits against the Oman Export Credit Agency? So it was announced before, so we didn't know the latest updates about it. So
we have the meter, if you can update, Sakshi.
Yeah, that with Oman, what they call credit Oman, we have case in the court, and the date of that will be 29th of April, inshallah. Inshallah, we hope to win that case from Oman credit, inshallah.
inshallah, we'll wish you all the best, inshallah.
Thank you. Thanks a lot.
Thank you, Mohammed.
Thanks, Mr.
Hello.
Yeah.
Hi. Good morning. Thank you for the presentation, and congratulations on a good set of numbers. Just a few queries. Firstly, I think you mentioned that one of the drivers for performance was some service orders which are extremely high margins. Did I hear that correctly? And could you just quantify what percentage that was in the first quarter, or was that in general for 2023? I just want to understand, firstly, about the service orders.
So actually, if you see 2023 quarter two, we have executed this order. This order was almost 0.8 million Omani riyal. It is not the one which has contributed mainly into the profitability, but it is one of the contributor, because this is one type which has come for the first time, as you see. But otherwise, there are multiple orders which are there, which were taken into consideration, which are primarily the resultant for the bottom line what we have.
Okay. Now, if I talk specifically about your first quarter numbers, I mean, very good set of numbers. What I noticed is, what stands out is the margin expansion. You've done a 10% margin, which I haven't seen for a very long time, on that base of 6.5 million. So, I mean, one is where you did 10 million riyals in the fourth quarter of last year, and I see that at 6.5 million, and I see the margin at 10%. Now, if I look at commodity prices, they've been stable, which is actually helped you, because you just mentioned that you have a 30-day lag between winning an order and booking copper, and all the previous orders you've already booked the copper. So if you could just give us some highlights as to what happened in the first quarter, and I can then probably formulate my questions after that.
You see, actually, we are working in multi direction in terms of how we work on the profitability and the sales. Okay. The first fundamental thing is the orders what we have. The orders are at a very better prices, primarily because we are focusing now on more of a strategic product, not on a regular product. So we currently are filled with orders which are specialized products, gives a better gross margins for us. That is one of important thing. Second thing is, in terms of the raw material costs which we have secured much of the raw material costs in those areas which are there. All the three SBUs which are there, we had, if you remember, you've been tracking us for quite some time. We have power unit, we have distribution unit, we have switchgear unit. Okay, switchgear unit was bleeding us a lot in terms of lot of orders coming at a higher raw material cost of 90, 95 and all. We are not able to make it out. After doing the restructuring last year, we are less exposed to that bleed, and that is giving advantage for us in terms of group profile. Apart from that, the distribution transfer business is showing a very good working in terms of raw material costs, and as usual, power is also having a better raw material cost. The combination of all the three companies and the product mix what we have is actually the resultant of what you see in Q1.
Okay. So if I were to look at the remainder of the year, and as a strategy for Voltime going forward, the focus would be more towards distribution transformers, towards higher margin products, and these sort of margins are sustainable in your opinion. And also, if you could just give us some idea about what sort of revenue run rate you plan to achieve, let's say on an annual basis, because I understand it probably wouldn't be on a quarterly basis, because last year first quarter numbers were poor because of lower execution, and you had subsequently higher numbers in second quarter. So if you could just give us some guidance over there.
If you see the year projection, what we are seeing is much better than what we have done last year, the 2023, as well as previous years also. But it's long time to go, because there are a lot of factors which influences. So what we basically do is we see projects which are there's a very, very healthy order book to just keep you understand on that. We have a very, very strong and healthy order book for 2024, because a lot of orders are there in power as well as distribution transfer, as well as switchgear division. So all the three units has a very healthy order book. So we are seeing that other than the project getting delayed or project getting any deferment, we see a very, very good revenue recognition during 2024.
Okay. And when it comes to sort of these margins at the gross level, it's something you're very comfortable maintaining going forward.
Yes, yes.
Okay. Okay. Um, Also, if you could just give us some sort of details on the joint venture that you have with the Saudi company Al Sharif Holding Group for high voltage transformers, as well as any updates on the qualification of power transformers with DIVA.
So if you see, last year there have been a lot of activities which has been done. Some of the fruits are realized early this year, Q1. To start with Saudi Electricity Company, we got approval in December 2023. And if you see the purpose of going for joint venture in Saudi Arabia was primarily driven through the agenda where Saudi Arabia Local Content Government Procurement Authority, which is the buyer of key transformers in Saudi Arabia, had a mandate that local manufacturer will get 30% of price preference. Okay, 30% is quite big in terms of the product what we are in, where the profitability is in single digit. So it was inevitable, but for us to go to Saudi Arabia, we were working for that since almost a year. May 2023 we started, and then finally we were able to have this joint venture done with a company called Al Sharif, which is also a approved EPC in Saudi Arabia company. And there are a lot of demand in Saudi Arabia which are there. We signed an agreement with them in February. The plan is that we should be starting. We should ground break for the factory location by June 2024. We should be ready with the factory likely by December 2025, and manufacturing start in 3 phases. The first phase will start in 1st January 2026. That is what Saudi Arabia is. When it comes to DIVA, we had, though DIVA is a very, UAE is a close by country, but DIVA as a country, as a utility is very, very stringent in the world. They have, because the area is small, the technical specification requirements are very stringent. They have been buying only European manufacturer, though there are a lot of other companies. They don't buy, DIVA doesn't buy power transformer from anyone other than European for 132 kV and all. So we have been working for that for quite some time. And finally, in February, we were able to have a meeting with DIVA. We got the people here and all, and we were able to get the approval from them. And we also got an order of 1.8 gigawatts of DIVA 6 project, which we are going to execute this year for power transformer, which is $15 million US.
Sorry, what is the contract size? 15 million US dollars.
15 million US dollar is one project of DIVA 6 renewable energy, but we are expecting 2 more projects to come for substation, which will be around 6 million US dollars. And this is just the opening. Then you have an ongoing continuous business with them.
And if you could just sort of give us some idea in terms of what products are these and what is the general margin, sort of back of the envelope margin for these projects with DIVA?
So if you see, I'll just correct my statement. 50, it's not 15, it is 16 million. 15 million we got for power transformer, 1 million we got for earthing transformers. These are 2 combined together, which we got it. And if you see, the gross margins are, despite we are entering this business for the first time, still gross margins are around 19.5%.
Okay, that's the gross margin on these products. Okay, interesting. Now, I remember that when we had spoken probably a couple of years ago, when things were looking, when you were looking at turning around the business, and you've done a great job. I think you had mentioned that as the head of the company, if you achieve 6 to 7% net margin, that would be a good job. And now, and a sort of revenue run rate of 35 to 40 million. So I think we were looking at approximately, if I'm not mistaken, around the 1.5, 1.7 million riyal as a good sort of net profit. And now when I see these numbers, I see 630,000 riyal of net profit at a almost 10% margin. And if I do the maths and you continue to maintain your run rate, that looks like a very, very promising number. So is that understanding correct, where you think this run rate for margins is sustainable as well as revenue sort of projection that you're sort of planning to achieve? Just want to understand, because then that would be a fundamental shift in the operating metrics for the company.
If you see in last investor meeting when we had in July for H1, our Q1 was very bad. We had a turnaround in Q2 and we were able to have some sustainable result for H1. Okay, and we were talking about the same thing. This is the question what you asked last time, and I explained to you that 6 to 7% is the general profitability of the business type what we are in, and the sales what we're seeing is 38 to 40 million. So seeing forward, if you see Q3 result, if you see Q4 result and all, It all depends on what is the type of mix, what type of products which are going into that particular zone. So you cannot just calculate the run rate. The whatever we have done Q1, maybe 750 into 4 is not what is going to happen. Maybe it will have a lot of impact in terms of what products and what services we do.
I completely understand that. I'm aware of that run rate. Now you've started the year with an 18 million real order book for which you already sourced, unexecuted order book for which you already sourced the copper. Is that correct?
Yes.
Correct. So that's great. And if I were to look at the execution time for this booked order, for this unexecuted order book, what is the general execution time period?
It's you can say 1 month to 9 months.
Okay, not bad. I'll tell you why. I mean, I remember back in the day, the Qatar orders, I think there was a delay in the execution, there was some miscommunication, and that is what actually made that project a loss-making project. So I'm just trying to understand what sort of execution timeline we're looking at, and what sort of order pipeline are you targeting currently in terms of projects that are being bid for?
So if you see, Panorama was a very special project, which was actually designed for 2 years of supply period, but because of multiple reasons, it went for 4 years. And that has given a lot of hit in terms of our raw material costs. And then the COVID and all were there. We had severe situation what we had. So we had learned from that, and we have decided that we will not go for any long-term contract in that way. And fortunately for us right now, we are not having any long-term contract of that kind, though we have 5 years of supply agreements and all. But those agreements and all will come based on whenever order is released. This is a framework agreement. Then you will have orders which need to go. So if you see, we are not in that risk of price going in a different direction for the long-term contract. When it comes to our current order book, we have order booking for some of the project till May 2025. Okay, for some of the companies, for September 2024 for some of the companies, and that's how it is. So we are not exposed to a longer lead time period commitment for price where price fluctuation can risk us on the bottom line.
Understood. Now, with regards to the sort of lawsuit that you filed, that amount of 400,000, if you were to win, would straight flow through to your bottom line?
100%.
Yeah, that's what we confirmed last time also, Vishan.
Okay, no, just wanted to touch base. And you said April end is the next hearing at least.
So that's the date which has been done, because there were 2 dates which has been deferred by them, and then this date has come. We hope they are able to conclude something on this period.
Okay, excellent. And just a final one before I go back into and let others ask their queries. In terms of margins, what would be the best products that the company sort of would push forward to? Would be power, then distribution, transformers? And if you could just give us some sense of...
So if you see in power transformer, the large power transformers has got a better gross margins. Oil and gas transformers of power has also got better gross margins. There are certain market which gives better gross margins. In distribution transformers, we have some strategic projects which are in renewable energy, which are there in regular products and all, where we have very, very good margins, sometimes better than power in some of the products. In switchgear also, there are some products which are having better gross margins. But otherwise, special transformers and large power transformers got better gross margins.
Now, I remember that you had... sorry, I'm just keep it on my mind. Given the current push for renewable energy that Oman has sort of emphasized on, do you see a lot of scope on that front with all these renewable energy plants that the government keeps talking about? Is that a huge potential for you? And sort of what market share of those projects do you see yourself winning?
If you see, Voltam is fortunate that we have been into renewable energy much before anyone thought about it. Voltam has supplied the first power transformer for renewable energy in Al-Amin power plant when Al-Amin started. Voltam supplied to Saudi Arabia, Repto 3, where no one was knowing about the plant. Voltam supplied inverter tube transformer to Saudi Arabia, the largest single contracted power plant of almost 1.5 gigawatts, when there are 7 other manufacturers in Saudi Arabia. So Voltam has done a lot of work in terms of renewable energy. Voltam is working on one more product which is going to go for green hydrogen, and that will be a game changer for all of us. So we have our footprint in renewable energy, and we are having multiple projects in hand right now, including NEOM. We have orders from NEOM. We supply to NEOM also.
What would be the size of the market that you would target in Saudi once the joint venture starts in 2026?
So you see, Saudi market is very can be divided into three parts primarily, and even the utility like OETC, what you are here, you have Saudi Electricity Company there. ACC market itself for power transmission is a billion Oman area.
Okay.
And there are competition. There are specifically Korean-based EPCs are there. There are Chinese-based EPCs are there. There are French and German EPCs are there, which are having a lot of good relationship with utilities, good relationship with their supply record and all. So we are looking after a small amount of business, which will take us a long way as we go forward.
And one last question. Sorry, thank you for your patience. You had mentioned one of the key risks for your business remains the lag between sort of bidding for an order and winning the order, and that's where your sort of raw material is unhedged. Now, how do you see that shaping going forward? That will always remain a risk for the business, or do you think that's something that you've been able to cover with your new strategy?
See, whatever strategy we put in place, it has a risk. The risk is slightly mitigated, reduced. The whole thing is the bigger the commodity price fluctuation, the risk multiplies. Okay, so we are like, as I said to you, we have orders which are to be executed in May 2025. Okay, if you have to execute in 2025, today if you buy copper, you are not able to hold copper for almost more than a year, more than 12, 13 months. If you buy that copper also, the price what you pay is quite large, and that is the cost which you need to bear. And you need to balance it off based on fluctuation and all. So what we are doing right now is, whichever order is hand which is available, we are on a rolling basis. We are ensuring that copper is available on a at least minimum 50% of the quantity which is to be delivered, so that the risk is at least mitigated by 50%.
Okay, noted. Thank you so much, and wish you all the best.
Thanks a lot. Anyone have any questions? Yeah, Joyce.
Hello, good morning, gentlemen. Thank you for the presentation and the answers so far. And congratulations on the good set of numbers for this quarter as well as the first quarter. See, I have a few follow-up questions. One is on the inventory planning that you said. You said you're buying the entire inventory ahead of time, probably 6 months inventory. Why haven't you thought about hedging this inventory on a futures exchange? Because the metals that you are buying, copper, aluminium, these are all traded on international exchanges. So why don't you think about hedging your position or hedging your demand in order to mitigate the price risk?
Okay, so first I just want to clarify and give some figures. 2019, the inventory at group level was 9.8 million. This has come down to 5.2 million in 2023. So that means we have reduced our inventory by almost 4 million. Okay, that's the first point. What we are trying to say here is there is a process where supply chain, the cost of delayed delivery, the cost of production loss, the cost of non-availability of material is higher than the cost of inventory keeping. Okay, that's the first thing. To avoid that thing, we're trying to keep the inventory which is there. When it comes to copper hedging we're doing. And we're doing copper hedging for 3 months, 6 months, 9 months also, so that we hedge the copper and keep the copper with the supplier. But here, the hedging is with the bank. When you're doing hedging with the bank, then you are fixing the price. But you're not, you carry the risk of price, but you don't carry the risk of inventory here.
Got it. So the risk is primarily on the logistics side rather than on the pricing side.
Yes.
And you mentioned in your presentation that the raw material cost has been brought down to 65% of the total revenue. So I just wanted to know what's the ideal target level that you're looking at for raw material cost in terms of with respect to the revenue.
The product mix what we are in, the product what we are doing, globally the raw material cost ranges from 70 to 73%. You take any multinationals or any manufacturer, that's how the raw material cost stands with. We have taken some strategic initiatives which has brought down these prices. It's multifold, as I said. It's design, it's material, it's the utilization, the reduction of scrap, the reduction of rework. Multiple things are there which has had a combined effect which we can see. So I don't want this figure of 64, 65% should be taken as a benchmark, because that's not a benchmark.
So you will try to be somewhere around 70 to 73%. That's
Yeah,
your
yeah,
ideal
sure.
number.
Yeah, that's the ideal number. If you're at 70, that you're doing good job. 73 is
With the industry.
yeah, with the industry, it's okay. So if you're doing less than 70, that means you've done something extraordinarily okay. So extraordinarily good.
So you have done, in 2023, you have done extraordinarily good, and in 2024 first quarter also, I assume that, it has been fantastic. So can you explain what are the reasons that, that contributed to this, and what are the reasons that could, result in this, this proportion going higher to 70%?
You see, there is since you asked, I'm trying to tell that it's more of design philosophy also. The transformer is a technology product. How you design the transformer most efficiently, you can have a transformer design most efficiently, completely in a completely different manner. We are working in various factors. We are not working in one factor, two factor. We are working in various factors. Electrical CRGO steel, which contributes around 25 to 30% of the steel, can be designed in such a way that the grade of the material, the source of the material, the type of the material, the cutting of the material, all these things, if you are going in a detailed manner, you are able to save money in a big way. And those are all actions which we are taking just in the design. So we do similarly on the sourcing, we do similarly on our pricing, negotiation, and all.
Okay. So what could result in an increased pressure on a high, further pressure on the raw material cost? Because you're doing it right now, you're doing it very efficiently. So
there are two factors actually. One factor I want to just share with you, even the sales price. Sales price is the major contributor in the current period. Actually, the transformer demand is high, and the deliveries are not coming from many people. Since the delivery is not coming, and we have created a flexibility in our manufacturing setup, we are able to deliver to the customer on time with a short delivery period. So when you have such scenario which is there, so you are able to get a better premium in the sales price. The moment you get a better premium in sales price, you get a better RMC. So sales price, higher sales price is a contributor. Your efficient working in design and purchasing is a contributor. And then this all combined together works out to you. And we don't have much of a commodity price variance which used to be there previously. And since that is also not there, so all are combining together for us.
Got it. So it's more of a function of pricing rather than the raw material cost.
It's all combined together.
Yeah. Okay. Okay. Got it. And when you said your focus, your order distribution, as well as your revenue mix is right now shifting more into the export side, which all geographies are we seeing further growth? Could you please provide us the geographical mix, like how much is from Saudi? Because you said African market is a little dull during 2023. So which are the markets that we are seeing some improvement, and which will be our focus markets?
You see, actually, we have been, Voltam as a company has been doing almost around 50% of exports for almost 6-7 years now. Okay, but there were only one or two lead drivers, like Karama was one of a driver, Ministry of Electricity Water, Kuwait was one of a driver, and this was one of our drivers which was there, and there was no multi-fold customer basis. Now with opening of Saudi Electricity Company, Diva and all, our market base in export has expanded primarily in Saudi Arabia, in UAE, in Yemen. Yemen, we are doing a good job in Yemen. We are now working in Bahrain. We are going to have good amount of orders from Bahrain. Qatar, still we are trying to see what we can do in Qatar, because Qatar is not a big contributor in last year also and this year also. In Africa, we are working with Nigeria is one of the major contributor to us, because Nigeria we've been supplying for quite some time. But Nigeria, we see that it is the money coming in is a bit riskier, so we work on LC only. Libya is a big market which we have opened up recently, and there also through private EPCs and all, we are secured. If you go with the direct utility, we had order with the utility last year, 2022 also. We did not execute because we felt that it is not safe. But if you're going through a third EPC company, we are able to have better terms and we are secured in terms of payment. These are the countries. Iraq, we are exploring on Iraq. We hope we are able to explore Iraq. And we are working on US also, which is there. We executed last year one job to Lithuania, and we got a follow-up order also from them. So these are the countries which we are primarily focusing on.
Okay. So, but these are small markets, isn't it? Like, when you say Lithuania and all these markets, small, but what I'm seeing is right now you have a order book of, let's say, almost $20 million, which is around 15% of the revenue coming from UAE. So, just wanted to see how much of a focus are we looking at, for the regional markets which are easy to access, and what's the competitive pressure that we are seeing there?
You see, in GCC, Oman is the 5th largest market. Okay, Saudi Arabia is the 1st largest market, then comes UAE, then comes Kuwait, then comes Qatar, then comes Oman, then comes Bahrain. Okay, and Saudi Arabia market is 10 times of Oman market. Okay, my capacity utilization right now, Oman is, if it's able to give me 35 to 40% of the capacity and balance I get from outside, is more than enough for me, for my capacity, what is there right now. For getting that 55 to 60% of the capacity from these 6 countries, these 5 balanced countries, is hardly 8 to 9% of the market share, which is not such big thing for me.
Got it. And what's the ideal capacity utilization of what level of utilization will you call it as a good utilization? Because
in terms of revenue,
production capacity utilization.
So you see, we have combined for power and distribution transfer, we have a capacity of almost 15,000 MVA. This is how we measure in terms of transformer. And 15,000 MVA, again, these are machine-based. There are 30% machine-based activity. There are 70% people-based activity. Okay, we load our people based on the order booking what we have, because no order is produced.
Hello? Hello? Mohammed, your voice is missing. Your voice is breaking.
Can you hear me now?
Yes, now, yes.
Yeah. So what I'll just repeat it again. So if you see 15,000 MVA is the total plant capacity for power distribution transformer. And this 15,000 MVA is dependent on 30% of machine-based and 70% of people-based. And all orders are manufactured based on receipt of order only. Nothing is manufactured as random. And since it is not manufactured at random, it's made to order. So you have a time period of 3 to 9 months to produce and deliver. So based on that, we plan the people so that the people utilization is almost 100% for us. And machine utilization is done according to that. The machine utilization is not done fully based on, you don't run for the order for getting machine utilization, but you load the machine based on whatever orders you have.
Okay. So let's say in some industries, or plants, it may not be able to achieve 100% nameplate capacity utilization. So ideally, in transformer industry, what would be a good capacity utilization? If you are measuring it by that yardstick.
80% is the capacity utilization.
Okay. Okay, fine, got it. And you are at 65% right now.
For 2023.
Okay, fine. Thank you. Another question that I have is on your Saudi project. You said the investment will be around 9.5 million riyals. Is it the total investment or Voltam's share of investment?
It's a total investment. We are 49% shareholder and they are 51% shareholder. So out of that 49 also, we have a technology collaboration arrangement, which will not have a bigger impact on our cash flow.
So how much is the cash flow and how are we planning to fund it?
So the cash out or the way we are seeing the investment for this is not such a big investment. I don't want to exactly tell what is the value, but it is not going to hurt us or it is not going to impact any of our cash flow.
Joyce, just to be a little more clear, that we are making our deal in such a way that that we do not have a major cash outflow from our end, and we can cover it through our technology agreements with them.
Okay, so probably we may not require external funding for this.
Yeah, correct. Yeah.
Okay. Okay. Generally that's it from my side, gentlemen. Thank you very much and wish you all the best.
Thanks a lot. Anyone else has any questions? So if you don't have any questions, we can close the meeting.
Thank you, everybody.
Thank you very much. Thanks a lot.
Thanks, everybody.
Thanks, everybody.